Most businesses don't have a productivity problem. They have a cash conversion problem. Teams are busy. Pipelines are active. Operations are expanding. From the outside, everything appears to be working. But liquidity feels tight because activity does not guarantee cash. Execution increases volume. Cash depends on timing and conversion. And when those two are not aligned, growth creates pressure instead of stability. This matters for founders operating in growth environments, agency owners increasing delivery capacity, service businesses onboarding more clients, operators expanding teams ahead of confirmed demand. The assumption is consistent. If we do more, we grow more. If we grow more, financial pressure should reduce. But cash flow does not follow activity. It follows sequencing. You can increase output and still reduce financial stability because growth activity and cash movement operate on different timelines. Execution accelerates commitments. Cash arrives based on collection cycles. If those are not aligned, the system becomes fragile. By the end of this video, you'll understand why activity without conversion creates liquidity pressure and how to structure your business to maintain financial control. The common belief is simple. We just need more sales, more outreach, more marketing, more deals. It feels logical. If revenue increases, financial pressure should decrease. But this assumption ignores how money actually moves. Revenue is recorded when a transaction is recognized. Cash is received when payment is collected. Those events are rarely aligned. At the same time, commitments begin immediately. Hiring decisions are executed now. Marketing spend is deployed now. Operational costs increase now. So the business begins operating on expected inflows rather than actual cash. Signed contracts create confidence. Collected payments create stability. That gap between expectation and reality is where financial pressure begins. As activity increases, pressure compounds. Hiring increases payroll obligations. Marketing expands, spend before returns are proven. Software subscriptions add recurring costs. Operational commitments grow quickly. Each decision looks reasonable in isolation, but together they increase financial rigidity. From the outside, the business looks productive. Internally, tension begins to build. Receivables are monitored more closely. Payment follow-ups become more frequent. Vendor payments are delayed where possible. Approvals become more cautious. Payroll begins to feel tighter. Revenue has not declined, but liquidity feels unstable because the timing between inflows and outflows has shifted. Activity increased. Cash alignment did not. There are three core risks driving this pattern. Revenue is not liquidity. Revenue reflects performance over time. Liquidity reflects available cash at a specific moment. A business can show strong revenue and still struggle to meet obligations. When leaders rely on revenue as the primary signal, they overlook timing gaps. They assume performance equals availability, but liquidity is governed by when cash arrives, not when revenue is recorded. Without this distinction, financial clarity is lost. Fixed cost sensitivity. As activity scales, fixed costs rise. Payroll expands. Subscriptions accumulate. Operational overhead increases. These costs are not flexible. They create consistent outflows regardless of cash timing. As fixed cost exposure increases, the margin for error decreases. A small delay in collections can create disproportionate pressure because the system becomes less flexible. Decision timing exposure. Execution decisions are based on expectations. Hiring assumes demand. Marketing assumes conversion. Expansion assumes growth. But expectations are not cash. When commitments are made before validation, the business becomes exposed. Costs begin immediately. Cash arrives later. If outcomes do not materialize as expected, or if timing shifts, the system experiences strain. That gap between commitment and confirmation is where risk accumulates. To understand how this develops, consider a scenario. A business generates $220,000 in monthly revenue. Payment terms are 30 to 45 days. Fixed costs are $130,000. The company decides to increase activity. 2 hires are added. Marketing increases by $35,000. New tools and systems are implemented. Fixed costs rise to $185,000. In month 1, revenue is recorded at $220,000. But only a portion of that converts into cash immediately. Expenses of $185,000 must still be paid. In month 2, revenue increases to $260,000. On paper, the business is improving. But cash from month 1 is only now being collected. If collections are delayed even slightly, or if new clients follow similar payment cycles, cash inflows begin to lag behind commitments. By month 3, revenue may continue to grow, but liquidity becomes tighter, not because revenue is insufficient, but because timing is misaligned. The business appears successful, but internally it is under pressure because activity expanded faster than cash conversion. To manage this effectively, 3 principles are required. Principle 1. Separate revenue from cash metrics. Track what has been earned independently from what has been collected. Revenue provides performance insight. Cash provides operational capability. Without this separation, leaders operate without full visibility. Principle 2. Sequence commitments after cash conversion. Do not scale fixed costs based only on recorded revenue. Wait until revenue consistently converts into cash. This creates a buffer. It ensures that execution is supported by liquidity, not assumptions. Principle 3. Stress test fixed cost expansion. Before increasing commitments, evaluate how the business performs under pressure. Assume delayed collections. Assume variability. If the system remains stable, expansion is controlled. If not, execution should be adjusted. If this discipline is ignored, fragility increases. The business begins relying on credit to manage timing gaps. Decisions become reactive. Leadership attention shifts. From long-term strategy to short-term survival, opportunities are missed because liquidity is constrained. Growth continues, but stability declines. This is not a productivity problem. It is a financial sequencing problem. Activity creates movement. Liquidity creates stability. Revenue can grow. Execution can expand. But without conversion into cash, the system weakens. The businesses that scale effectively are not the most active. They are the most aligned. They understand timing. They control commitments. They prioritize liquidity. Executions is not the issue. Unvalidated execution is. Revenue fuels growth. Liquidity protects survival. If you value structured breakdowns like this focused on financial control and operational stability, subscribe for more strategic insights.